I want to take a few minutes and talk about the concept of paying tax on money you're not even using. You might be thinking, well, how is that possible? Well, let me give you a couple examples. First, simply put, you have an investment that's outside of an IRA. They call it a non-qualified account. And let's say it's invested in a stock that's producing a dividend and you're reinvesting that dividend. Well, as that dividend comes out, you're paying tax on that dividend even if you're not using it, right? And so therefore you're paying tax on money per se you're not spending or using. Let's take that scenario one step further. Let's say you're retired and have Social Security. Well, that Social Security is coming in, and that alone, based on all the formulas and how you calculate that, if that's all you had, you're likely not going to be paying federal income tax on that. Well, let's say you have these dividend stocks, again, producing that and you're reinvesting that dividend. It's possible, depending upon your incomes, if you have a high enough taxable situation on those other accounts that we're talking about, it may make a portion of your Social Security taxable. So wow, not only did I pay tax on that money I'm not using, it's also potentially causing tax on money that I am using. So it's one of these situations where typically, when do we want to pay tax? Well, depends. A lot of times it's when we use it, typically one would say, but also you want to pay tax in the years that you have the least tax liability. So once again, you hear us all the time, tax planning, tax planning, tax planning. How can we figure this out? Map out your years, look ahead. Where will I have certain incomes? Where's maybe capital gains coming into? Where do I need to take required minimum distributions? Do I have these accounts that are spitting off interest and dividends that are potentially causing additional tax I'm not using? Some people call that phantom income when they look at those situations. So once again, like I said, you usually want to pay tax when you're using it, unless there's an opportunity to offset that or pay that in situations where you don't have as much tax. Makes sense? So once again, let me give you an example in that scenario. Let's say I'm 70 years old and I have my RMDs are coming at 72 years old. I have these non-qualified accounts that are doing this. I have an opportunity before my income may rise at 72 to potentially realize some of these gains, realize some of this income, pay the tax, and adjust the investments to something that maybe not producing that anymore. I have maybe deferring taxes and such like that. So once again, depending upon your individual circumstance, this could cause excess tax on money you're not using. Wouldn't it be nice to know you're in the best possible situation for that? Give us a call on the screen. These are situations we deal with every day in helping you map out a tax plan for your retirement to be the most efficient as possible.